This is a Momentum Media production.
Nerd alert! Property Nerds, the home for data-driven property investors, where we uncover Australia's hot and cold markets, latest headlines and trends.
It's Arjun Paliwal here, and we're back for another episode of the Property Nerds. And today, a bit of a different episode because we've got some interesting, fun, and exciting collaborations going on. And Lee is not in the house for today's episode. As some of you may know, we are both expecting our first child. And so as a result, naturally, Lee can make some things and can't always make some things. She's keen as to be on the show today and join us, especially with a special guest that we've got on. But she wanted to have that time, and we're both pumped for, I guess, the start of the whole family journey and things like that. And then a little bit nervous, but happy nervous. So can't be any more excited. And in terms of today's episode, we're going into the world of our research papers again, but this time we've actually done our first ever co-collaboration. And so I think co-collaboration, I'm just thinking back, is that even a word? Because collaboration is like you're with someone else. Isn't co always a collaboration? Anyways, that's a side one. But we created a new word here today. And so everyone who's been in the house has been tuning in, and we often share research papers. And at InvestorKit, we've been doing this for over a year now, and coming up to, I think 15th launch or 16th launch of these monthly papers. And they have been getting immense attention thanks to you all who tune into the show. And on that note, we've actually crossed over 300,000 downloads. So a big thank you to you all who've supported everything and more on the Property Nerds podcast. And we're just glad that you're loving this, getting a lot of value. Because if I go back to when I first started, I wasn't quite sure if the data numbers was going to flow through audio so much, since it's typically quite visual. And that's how we work in our world, especially. But it's been well received. So thank you all. So we're going to continue that, and we're going to continue sharing these research papers here from the InvestorKit team and keep them regularly on a monthly basis. And in today's episode, I get to collaborate with someone who's not only a very, very talented individual in what they do, but they actually are also a dear friend, someone I've known for many years and been, seeing on their journey and their growth, and, someone I pick the brain on from time to time as well over the last 5 years, because an absolute mastermind in the world of finance. So I've got here with me, Redom. Hey, Redom, how are you, mate?
Hey, Arjun. Absolute pleasure to be here. So much to congratulate you on. Becoming a father is very, very exciting. This research paper, 300,000 downloads, well done. Yeah, it's a pleasure to be here with you.
Thank you, mate. And look, the pleasure's mine as well to be here with you. And for those who haven't met Redom, I'll give you a little bit of my understanding and my spill of Redom, and then I'll get him to fill the gaps in case I've absolutely botched it. But Redom is the co-director at Confidence Finance. And if that name doesn't give you confidence, I don't know what will. But how about this? Redom has a background in property investing and finance and research and economics. And these are some of the core factors, right? Because it's market trends, it's skin in the game, and it's finance actual output. So when it comes to that, they've settled almost at 500 million plus in terms of lending. They've been having personal portfolios amongst the team. So Redom's portfolio is a multi-million dollar property portfolio, and he has been successful across many aspects of personal investing. But he also comes from a background of ex-Treasury, come from the Ernst & Young, or EY, for those who love their acronyms in the corporate world, and economics, finance, all of those backgrounds put together. And I've had the pleasure of having Redom on InvestorKit podcast show, actually. And this is the first time we're here together on the Property Nerds show, because he loves his data, he loves his research, but most importantly, he practically breaks it down and allows you to implement the outputs of quality research and data. And that's the difference between those who truly understand something versus those who know something. And that's the big difference you want as you enjoy this podcast episode, and as you go back to any others if it's the first time tuning in. So, Redom, that's my little intro for you. And yes, I do take credit card.
That was very, very kind. I can't do better than that, Arjun. No way at all. Yeah, the key point that you just said is about understanding research. And the best thing about this research piece that you've just released, that InvestorKit's about to release or has just released, is it gives actionable and practical tips for investors. It's not just data, it's not just information, it's broken down to information that someone can use and broken down to what their next decision point can be from the research that you've done here. So that was my favorite thing reading through this. it's great to be here, and I can't wait to get into it and talk to you about it.
Thank you, Redom. And so, mate, obviously I can't take all the credit here. This is a co-written research paper here by the Confidence Finance team and InvestorKit. And in particular, we're going to be deep diving into the findings. And the topic itself is the 5 rules for investing during high interest rate environments. And there's nothing more topical than that, than looking at the last sort of 15 months and seeing where the market cycles are. But Redom, if we start very high level, 5 rules here. And we're going to spoil some of the rules in advance. But if you were to pick out one of them that I guess stood out the most to you and something that mattered the most to you, which one do you feel would be the one of these 5 that maybe we should talk about first?
I think the key to this, the number one rule, is that individuals matter more than the market itself. So this is all about how an individual's investor's situation is the number one factor to determine their next steps. The market is something outside their control. So it's about understanding the market as much as possible and understanding where in the marketplace suits that investor. So this, in my opinion, is golden rule of this report and also in investing in general. It's about the individual and understanding that there are different times, market cycles and things like that, but you matter more than the market.
Yeah, that's a very interesting point, mate. And when you think of that, I guess we talked about a few points, and this was almost like how to always remain, I guess, ready to buy. And this is a point that we both enjoyed talking about, because that you part, not so much the market, and really understanding that readiness of buying. This is something people underestimate, because I think there's people on 2 sides. One is they didn't know that they were ready, but they thought they weren't. And then one is the eager beaver who thinks they're ready or wants to have a crack at it, but probably shouldn't be investing. Could you take us through maybe unpacking this for all the listeners today?
Yeah, sure. So there's some key rules that you kind of want to follow if you're going to become an investor. So one very, very easy to understand one is, are you actually saving money? So this goes back to Economic Principles 101, where investment itself, the first thing that comes to it is saving money. So if you can save money yourself, then you have money to invest. So that's probably the starting point. And one rule that we've put into this research piece is about 25% of your net income. If you can save a healthy balance and you can see your savings rate grow over time, you now are in a decision point about what do you do with those savings. You can invest in cash, which is probably the most common lazy form of investment. It's what you do when you do nothing else. But over time, historically, over long periods of time, that is not going to deliver you returns and growth that other asset classes will. So action is important from there. It all comes down to, as a starting point for the eager beavers out there, is you got to start with savings, because that's generally how you start property investing, or it gives you a good signal that, hey, look, you may want to become a property investor because you're in a position where you're saving week to week or month to month.
It's a very important point, mate. And what that's made me realize is that whilst that's more relevant than ever in the high interest rate period, it's actually just as relevant in the low interest rate periods. Because if you go to both sides of the equation and you talk this beautiful and most exciting trend that we used to, the buzzword called positive cash flow property. And if we talk about today's market, it almost doesn't exist, right?
It's true.
Because you can take holistic views of cash flow. By the way, someone's going to pull me up on this and go, no, but it exists because 6% yield, 7% yields are out there. They are out there, but if you take into account rates, water, council, insurance, maintenance, vacancy, I call bullcrap if you think a 6 to 7% is positive cash flow today, right? And so we both know that. So therefore, if you're buying property, if you're not saving, you are already going into the negative day one. So your savings acts as an ability to handle the negatives. And that's the difference now, right? People have to handle the negatives. And so when you now flip this over, when you go to the positive cash flow times, this is where it gets interesting. You might think that, hey, you're not needing to save because it's positive cash flow. But even the high 5, 6, 7% yields back in the day when they were positive, were actually only positive on a 2, 3, 4, 5K per annum. All it takes is a couple of split system air cons to go, or a hot water system, and suddenly that cash flow is getting dipped into again. So you must be a saver if you want to be an investor. So thank you, Redom, for point 1. What was point number 2 on that, man?
Let's get into it. So one of the details, so this get the detail about investing itself. So most property investors begin investing with debt. So they're not going out there with cash and just purchasing a property itself. So that's the reason why we talk about negative cash flow and positive cash flow. Otherwise, almost all property investments will be positive cash flow if you're just using cash to go and purchase. But most people take on mortgage debt. 80% LTVs is quite a common, probably the most common LTV ratio when you go and purchase a property investment from the broader market. Lower amounts for other groups and higher amounts for younger investors. So you'll find that you'll be in negative cash flow when you're at 80% LTVs in high rate environments. But it's about understanding your finances and understanding those numbers in different rate environments. And today is a high rate environment. So it's about understanding what it looks like, because your financial position will determine whether you're ready to make that next investment or not. So in higher rate environments, we're changing the numbers, we're changing the hurdle rates, we're making it harder to pass. But those that do pass under these settings are more and show that they can continue to invest, they will still be able to get money from banks, typically, because they can demonstrate serviceability, and their cash flow demonstrates that, hey, they're still saving even in a high rate environment. You're probably in a setting where you want to be moving your assets from low return assets over time, historically low return assets like cash, to riskier assets like property, and other asset classes, to just essentially compensate you a little bit better for inflation over time. So that would be a key part. Know your numbers and know how to break down your numbers. And we go into depth in this report about how to actually do that, P&I repayments, interest-only repayments, what it looks like, how to stress test, and how much of a buffer you need per property to actually work out whether you're ready to invest or not. So there's practical tips in this report that give you that breakdown.
Yeah, it's a key part in terms of that risk management piece. And that's what we're talking about here, right? We're not talking about what a traditional property, expert or commentator would say, which is just go buy it and it's always great to buy. We're starting with the risk and management fundamentals, because if you manage them, it's all about knowing that when you gain comfort in the process, whether it's buffers per property, minimum rental yields, purchase price limits, or even percentage of net savings per month, you start to control the factor that, really either gets excited or stressed when you go into investing.
Yes.
And then you start to then go, now I'm in the market, I'm able to do these things. And so it's such an important part regarding these factors. But one thing that stood out to me the most, Redom, of what you said was, if you are satisfying tests of finance in this environment, you're probably really okay, because they're measuring you at 7, 8, 9, 10% assessment rates these days. What are they traveling at these days, Redom?
Pretty close to 10%. So, an investor borrower rate, call it 6% with a 3% buffer. That's a 9% interest rate that they're buffering you on, that they're assessing you on, as if mortgage repayments are going to be based at 9%. If you're taking on an interest-only loan, which a lot of investors do, the effective assessment rate is kind of closer to that 10% benchmark rate, because they reduce the loan term that they assess you over. So 10% is just a really good benchmark number to be like, hey, that's what the bank is stress testing me on, and the bank is still giving me funds because I'm effectively a high saver in this environment. Probably means that if you've got savings and a deposit there or equity there, and you're in a positive cash flow situation in the bank size at a 10% assessment rate, it's, you're a healthy borrower at the moment. So you might want to consider whether taking a deeper look as to, should I take on more risk in my portfolio and look at investing in property? So that's the starting point.
Awesome. So Redom, that's another rule that's quite important, right? You matter more than the market. Now, mate, I want to talk about one of my favorite ones. There's always something somewhere growing. And this is rule number 5. And I know for those following along or listening in, we're jumping from rule number 2 to 5, but this is just more so me and Redom picking out what really stood out to us. If you want to grab yourself a copy of this report and you're tuning in, investorkit.com.au, our white paper section, and you see it produced by Confidence Finance and InvestorKit. And that's 5 rules for investing during high interest rate environments. And rule number 5 is one of my favorites because it's the biggest myth buster in the space of property investing. And the fact of there's always something somewhere growing. Redom, when you hear this, what does this mean to you when it comes to analysis of property markets, especially during high interest rate periods?
Yeah, this is a wonderful point. So Sydney investors can often get caught up and think Sydney is the only marketplace in Australia. And there are many, many markets, and they grow at different rates. So from a portfolio structuring perspective for investors, this offers you a big opportunity. It allows you to invest in property, but be diversified in your return profile by investing in different states. So diversification in finance theory is a form of insurance. And by diversifying your assets into different locations that are growing at different rates and are correlated to different things, so Sydney may be more correlated to interest rate changes than Adelaide, perhaps, it offers opportunities for investors to split their portfolio, look at different cities and look at different locations to, add in buffers and protection to their portfolio. So something somewhere is growing. So if you understand that and you recognize that, and markets do grow at different paces, then you can benefit from that by investing in different locations. That's my key takeout. And, InvestorKit does some wonderful research here about where those markets that may be growing specifically are at different points in time.
Yeah. And I think on that note, Redom, like when you think of your clients that do come to you for finance and you help them out, what sort of purchase prices do you see ranging from? Because this is another interesting part. You talk about the Sydney investors thinking
Yes.
Sydney is Australia,
Yeah.
but that also does mean that people in Sydney sometimes think that if I don't have $1 million, I can't invest. Where do some of these purchase prices range from when you start to help people with confidence?
Yeah, it's true. It all ties back down to income. So, the very high income profiles will probably be more comfortable investing in at higher price points. But that makes up a much smaller percentage of the market. In this report, there's some great research about the quantiles, the percentage quintiles of the marketplace and where demand has fallen relative to others. And through this rate rising cycle, we have seen more demand shift to lower price properties. That's just affordability at play. So we see clients purchase pretty much across the country at different price points, but the majority of investment transactions are probably between the $300,000 to $800,000 range across different capitals and regional and big regionals. And yeah, that's probably where the bulk of investment activity is, while obviously really high income clientele would be looking in other markets and often purchase different types of assets too.
Yeah, that's actually a great call out. So we, in this report, for those tuning in, this is page 10 of the report. And this was under the rule number 2. And there was a percentage of sales volumes in median price quintile. So what that was we looked at March 2022 and March 2023. And this 1 year of data and looking at the different quintiles. So first, second, third, fourth, fifth, and fifth being the highest price, first being some of the lowest price. And what happened was, in my opinion, 2 causes. One was the borrowing capacity cycles shifting and people having cost of credits, meaning their borrowing capacities are down 30 to 40%. And then the second reason was naturally in hesitations and being forced to spend lower, you end up going to lower, seeking higher rental yields for investors and seeking more affordable stepping stones for buyers too. And so also first home buyers started coming into the mix, and that too was granted in the more affordable space. And so what we saw was on the 5th quintile, the most high in premium price points, transaction volumes moved from 16.1% down to 14 on the year on year. On the 4th quintile, it was 19.3 down to 18.8. So you can see the top 2 sort of premium buckets of property reduced their transactions. But then if we go to the most affordable 1st quintile, transactions jumped from a whopping 16.7 up to 20% volumes in that point. Oh. So even though property is more expensive today than it is for, say, 3 years ago, 5 years ago, that 1 year shift suddenly was people going to operate in more cheaper prices just because of borrowing capacities and that. So such a good pickup made. And when it comes to this final rule, Redom, I think another thing that, we were talking about, pre this show as well was actually just how little the interest rate periods of rising have actually correlated with areas and markets falling, which is very interesting to see. So if you think about, the Melbourne market, we took this in this rule number 5, which was page 24. And we looked at rule number 5 where we saw, hey, something's always growing somewhere. And do they always grow or fall with interest rates declining or growing? And when you look at Melbourne, it actually declined 6 times over 1977 to 2023. Like, firstly, can we take a small pause and just go, hold on a minute? 6 declines in 40 like almost 50 years now, actually 50 years of data. I'm showing how difficult that was to calculate. That's how fast time is, right? Time's flying. But mate, 50 years, doesn't that show you something interesting, firstly, on the property front of resiliency in Australia?
Yeah, for sure. This cycle has shown something, and it's something I'm learning because it's probably my first experience as a property investor seeing a rapid rate rising cycle, is the resilience of Australian property. We've never had, this is another statistic, not in this report, but similar to one that you've just said, is we've never had 2 calendar years of negative growth in Australian housing. This is Australia national in 40 years. So the last time we had 2 negative calendar years was, in the 70s at some point. It's pretty amazing. It showcases how resilient markets are and how quickly adjustment periods can be as well. So downturn periods can be over much quicker than one expects and thinks about. So we saw some adjustment, definitely, particularly in Sydney and Melbourne and Brisbane as well. Across the eastern seaboard, we saw a fairly material adjustment when rates began rising last year. So it was a little over a year ago where the Sydney housing market was deteriorating pretty quickly. So that sensitivity was there. But now as rate rises, or the pace of rate rises has slowed down dramatically compared to last year, and we're more accustomed to a higher rate environment. There's no shock to rates that's occurring at the moment. Yes, it is dialing up progressively, but there's no more shock in the minds of Aussies out there. We kind of expect it now. The markets, like the Sydney and Melbourne housing markets, have shown much more resilience as well. So that top quartile that you just talked about, they fell the most to begin with, and transaction values fell the most over that year period that is covered in this report. But that is showing that the most sensitive markets to interest rate changes have been the higher debt size markets and the higher price markets. So yeah, there's a lot of interesting research that's been coming out and data that's coming out from this rate rising cycle, because it's the first time we've had it in such a long time.
Yeah, I think, Redom, that, what that's taught me? The power of sentiment. That's what that's taught me, because when I think of fundamentals to me mean that someone can or can't. Like you fundamentally can or you fundamentally can't have something go in a certain direction. And this last 12 months has been an absolute display of the opposite. It isn't a case of can or can't for Australians. It was a case of, do I want to? And so what that meant to me was going, hey, people didn't want to transact, because if financing was a huge issue, we would not have seen a refinance boom. We saw a refinance boom.
Yes.
Right. And so to me, that says this whole I'm stuck, I'm in mortgage prison was nowhere near as bad as people were saying, because everyone was moving. You cannot refinance if you're not stuck. Like if you're stuck, you cannot refinance. Yes, so that was the first thing I learned, that Australia is more a country of if I choose to or don't to, is more of a don't want to, is more powerful than a do I have to, because people's positions are far stronger than what many anticipated.
Yes.
I'm not saying there aren't people hurting. And I'm not saying that there aren't people impacted by this. There are totally people out there. But on a mass majority, spreadsheets, charts, whatever you want to call it, data review, delinquency rates remain super low. Supply remained super low.
Yes.
Finance movements very, very high. And price decline depth or length of cycle in certain areas was very short. Yep. All clear signs of things shifted. Like you said, the first interest rate cycle I have seen, you've seen, in Australia to go in this direction. And it was just a whole bunch of confusion of what should I or do I? I'm not sure if I should. Maybe I'll sit out. Maybe we should hold. Maybe we should watch. And as that cloud is passing for many, and not saying interest rate cycles are over, but as it's passing for many in terms of the confidence piece, we can all agree that the majority is behind us. Whether there's some left or none left, no one can sit here and say that the majority isn't behind us.
Yes.
And so I think that's the biggest thing I've learned, is how important sentiment is, both now and in history of when COVID as well is another great example. But I think moving forward, when it comes to our data modeling, yes, we factor sentiment, but more than ever, we're going to look at ways of capturing sentiment more and more in unique ways, using AI, using some of the modeling we're building to capture sentiment more than ever, because I think that's what the last sort of 3 years has showed me, from pandemic to interest rate cycle, is it is a huge impacting point in Australian property.
Yeah, that's a great point. That sentiment being a larger and faster contributor to changes in direction in prices, I think is partly a function of the amount of debt in the system now. So at least with interest rate changes. So because of the quantum of debt being much higher, Australian households are carrying much more debt than, a decade ago during the last rate rising cycle. It means that the speed in which price changes occur and markets shift is happening quicker. So that could be data, access to information, sentiment being a big one. These are making faster changes in directions. So if you look at price charts, particularly of Sydney and Melbourne, you'll see greater volatility over the past 7-8 years versus the 2 decades before it. So you'll see 2 of the biggest decline periods that these markets have ever recorded. And sandwiched in between them is 2 very large boom periods, all happening at the same time. So that's suggesting volatility is applicable to housing markets now. So that's a little bit of an interesting change. And I think that's being driven by credit markets and the size of the debt profile that Aussie households have and the sensitivity Aussies have to changes in debt conditions as well. So there's some interesting research bits that are coming out, putting in a retrospective lens and taking a look. These are some takeouts that I've seen.
And Redom, on that debt review piece, there's obviously a few changes that are coming to the marketplace outside of this research paper when it comes to assessment rates. And for those who want to just know and remember our call on assessment rates, in previous research papers, we said some of the 5 trends to look out for, or 7 trends, I think it was, to look out for 2023. And some of those trends incorporated assessment rate shifts. And there are some shifts happening in that, not officially APRA-wise, but still. And it's still happening amongst banks, and they are in play. Could you give us some intel on them? Because you've had a lot of people reach out to you for refinancing. So I'd love to know more about some of those rules and what's changing and how also people can get in touch with you on the financing part for that, because it's a very important part considering the times we're in right now.
Yeah, this is particularly important for investors. So what's changed is for an investor who simply wants to refinance their portfolio from one bank to another. So this is no new debt, no changes to the debt that you have other than swapping it from one provider to another to lower the cost of that debt and to reduce your repayments as a result. Banks are far more willing to do that than they were just a few weeks ago. So investors in particular have been hit with big borrowing power changes over the past 12 months. That's because they hold a lot of debt and the assessment interest rates have gone up and the assessment rate's at 3%. So what they've done now is a number of major banks and smaller institutions are offering investors a chance to change their debt to them, take advantage of refinance rebates that might be out there as well, and reduce your repayment by using a much lower assessment rate on your debt. So this is someone who is repaying their debt. The bank's saying, if you're repaying it there, then you may as well come to us and continue your debt obligations. We're going to make it a bit cheaper for you and put you on better terms. That refinancing has come to light over the past month or 2. And this really helps investors because it opens up options to target their debt portfolios and make it a little bit cheaper for them. So it's a really good option for investors out there at the moment. And it's a change that it's kind of taken us by surprise a little bit. And it's just come out over the last 60 days.
Yeah, that's a big part because I think right now it's just a sign of common sense. You know what I mean? Yes. But I'm glad we're actually having a good balance of both. We're having a balance of Australia's tough lending laws that allow people to be assessed at 9 and 10% rates. And that is the system that has protected us today. I think that's fair to say. Look, whilst a lot of people are not happy with that, it is the truth, because had this interest rate cycle occurred and we had some of the parameters of lending in some other countries, we would not be in a pretty scenario today. I can tell you that right now. But because of our fantastic lending laws of the years in the past, that's created some buffer management for many up to that sort of 7% mark or a little bit above. And now we move into 9 and 10% mark. So, I mean, God forbid any interest rates ever get to there, but at least it's good to know that the households are sitting there. And now we mix that in with a little bit of common sense where people are unlikely to ever see those interest rate cycles. And we're now having assessment rates. So really good call out. And Redom, just on that, how do people get in touch with you on Confidence Finance to be able to reach out with the team and have a chat on those refinances? Because they are, not as smoothly operated by all brokers, because there's a lot of unique policy that happens underneath it that you need to be able to understand.
Yeah, that's very true. Yeah, we've been doing a lot of this business over the last month or 2. So reach out to us if you want to review your finances and see if you qualify for this. So if you're an investor with non-bank lenders, it's worth asking the question in particular as to whether you qualify for this or not, because you'll probably find that there'll be a rate reduction process for you and you'd be a big beneficiary from this. So to reach out to us, www.confidencefinance.com.au. You can reach out to me personally on LinkedIn as well, Redom Syed on LinkedIn. I'm there every day. So yeah, those will be the avenues to reach out to us. And yeah, I can just give that message to all investors. If you haven't heard of this, and you've been in a position where you think you don't have financing options, take another look now, because you may be able to reduce your repayments from these new lending policies that are out. They haven't got all that much attention as well. It's worth highlighting and communicating this to investors in this position.
Yeah, perfect, Redom. And for those who are keen to know a little bit more about the rest of this research paper, there are a few other rules that we haven't uncovered. And for you to uncover them, learn more about them, I'll give you a few of the headers, but I promise you'd want to download this report. It's totally free, as all our research papers have been. And that too, every single month we put these out. Rule number 1, undersupply for sale, building and rent. Lots of things going on fundamentally in Australia that will be covered off in that rule. Rule number 3, the local economy matters more than the macroeconomy. And there's a bit of a deep dive into some localized economic data, which should help you figure out what's happening. And rule number 4, inflation might be your enemy now with interest rates, but I kid you not, it will be your enemy long term if you don't do something about it. And that is why doing something is better than doing nothing when it comes to investing. There are sayings and people twist the saying however they want to. Some people say cash is king. Some people say cash is trash. You make your own decisions and you decide what you think is the way forward. But these are the 5 rules in this research paper. And Redom, I want to thank you so much for joining me on the show. That's Redom from Confidence Finance, and also for collaborating on this research paper. Redom, yourself, and Jung, our favorite research analyst, because she's the only top dog research analyst there at InvestorKit. And with the rest of the InvestorKit team as well, and us and data science and the junior research analysts in the squad as well. Thank you all. Everything here coming together has produced a very, very helpful research paper. And with all this here, I'm confident Aussies tuning in will be able to figure out the 5 rules to really ensure, whilst you're investing in interest rate periods that are higher, you can protect yourself, because these protection points will not only help you short term, but long term. And of course, get any appropriate advice, whether it's buyers agents, financial planners, whoever it may be, to get the right advice to help you on your journey. So thank you so much, Redom, and thank you everyone for tuning in.
Absolute pleasure. Catch you, Arjun. Cheers.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Game over.